Well, if I start why we put a risk hedge on the portfolio about 4 weeks ago, we were very concerned with the developments in Europe, and particularly concerned that it looked to us that the sovereign debt crisis in Greece was going to rapidly or potentially rapidly spread into other countries, and the policy issues were incredibly complex to deal with this issue. And you could have had a situation that if it had spread into other countries, the financial system in Europe could have got under enormous strain. And at that stage, if it had happened, it would have been a very, very difficult issue to have dealt with politically and from a policy perspective. So we decided about 4 weeks ago that we were going to further de-risk our portfolio, and what we did is we had about 2% cash in the portfolio, and at that point we sold down part of our portfolio to go to 12% cash, and we particularly focused on parts of the portfolio that would have been exposed to a financial system risk, and that was around our financials exposure. And so we took our holdings of cash up to 12%, and then we also took our cash resources out of Australian dollars and into United States dollars at about 93 cents. And we felt that was a very appropriate action to be taking given the risks that were inherent in Europe at that point in time. Well, we do think it is very likely, not certain, but very likely that there will be a slowdown in the rate of fixed asset investment in China. They stimulated their economy in 2009 and in the early part of 2010 by investing massively in infrastructure and property and additional manufacturing capacity, and it was very, very effective to hold their growth rate up. We don't think that rate of fixed asset investment is sustainable in China. If they do sustain it with credit growth, as they've been doing, they run the risk of putting enormous strain on their financial system and some huge speculative bubbles building in the economy. We don't think we're there today, but we do think we could head in that direction, and therefore we think China will have to slow down this stimulus-style expenditure that they've been on. And if they slow it down, given it's been investing in fixed assets, we would anticipate over the next 12 months that, it's pretty likely that you would see the consequences of such a slowdown, such as a fall in commodity prices, and also maybe exchange rates that are sensitive, like the Australian dollar, being affected. Couple that with Europe, that is going to slow down as well, or certainly not recover in that time frame, which further compounds the issue for like commodity exposures. That's a very good question on Yum Brands. Yum Brands is 40% exposed to China, but it isn't really exposed to fixed asset investment in China or the commodity story or the financial stories in China. It's really exposed to the consumer story in China and the potential for them to continue rolling out new stores. They have about 3,400 stores in China today in KFC, and they're rolling out about 600 a year. And really what happened in the consumer story in China, it was still growing at around 15%. It didn't get very affected by fixed asset investment. So there could be a very mild impact, but we think really that any slowdown in China is not going to be that correlated with what's happening with the consumer in China itself. So we are very, very relaxed on the short term and particularly encouraged on the long term story for Yum out of China in particular. Well, most people don't probably understand the business that we have most interest in. Most people would understand the e-commerce eBay site, where it's effectively a retail store in the sky, where vendors go to sell their goods, and buyers, 89 million buyers, consistently go and buy goods on the eBay site, and eBay collects about 8% of the value of the good for transacting. We think that is a very, very solid business. It's not going to grow at the rates it used to grow at. So it's a relatively low growth business, but a very, very highly cash generative business. The business we are particularly interested in is a business called PayPal, which is an online payments business. It is really an electronic wallet business. At the moment, eBay transacts $77 billion worth of payments over that PayPal site, and it collects about 2.25% of the value of that in terms of its revenue it generates, and that's been growing at over 30% a year at the moment, with 85 million users that are growing rapidly at the moment. We see that as a business we call as a network effect business. It will get the growth of e-commerce, plus the applications are far, far wider. And if we look over a 10 to 15 year time frame, if we're right about that business, which we don't think you're practically paying anything for in eBay, which is trading at about 11 times earnings at the moment, you are potentially buying one of the largest scale, high growth businesses in the world in PayPal. It's only about 30% of eBay's earnings at the moment, but over the next 5 to 10 years, it's going to be the dominant driver of that company if we're right, and you're paying a very, very modest price to get exposed to that at the moment.